and they wonder, how they should alter their strategy. Maybe.
Lots to discuss, right? So let's take that forward now. And let's welcome Prableen Bajpai, the founder at FinFix Research and Analytics, to talk about creating a strong and a balanced portfolio, especially when we are so close to record highs. And that's exactly the first question, Prableen. Thank you so much for joining us. We are pretty much at all-time highs. How does someone getting into the market design their strategy? Is there something you would do differently considering we are so close here?
Hi, Sonal. Hi, Pavitra. Absolutely. I think this is such a tricky, interesting question, but, tricky one to answer. So I think let's first establish that, it is absolutely impossible and very, very hard to time the markets. And markets, Sonal, typically belong to those investors who participate, are present. So definitely entering the markets, even at elevated levels, is fine, but the strategy can definitely vary depending on the levels at which one is looking to participate. Having said that, if we look at the calendar year returns of Nifty over the years, from 2000, we'll see that, it's only 4 calendar years when Nifty has actually given negative returns. So it sounds, like a very strong case for investment in the equity markets. And it does seem like that, all investments would have done. I think markets, go through their own drawdowns, and I think it's important to look, what happens if we are actually caught up in one of those. And Nifty has seen big falls of as high as 60%. That was during the 2008-2009 financial crisis, followed by what we saw during the dot-com bubble, then COVID. That saw almost a 40% fall in Nifty. So we have these 4-5 periods which have actually witnessed where markets have seen huge corrections. And I think going back historically can actually give us some ideas, what kind of a strategy does one, can deploy in such times. So the first, data point which I want to discuss here, Sonal, is, how do these markets actually affect a SIP investor? So I'm going to pick up to start with, and let's say that at 2008 highs in January, somebody started with an SIP, and that was the time when Nifty had hit about 6,300 levels. And if the person stayed invested right from January, was doing SIPs until now, the returns for the investor would be somewhere about XIRR of 11%, 11.5%. The same person, if started investing in October, November of 2008, when the markets had hit a low and Nifty was at 2,500 levels, would have also made around the same level returns if he or she was an SIP investor. And something similar is seen for the other periods of drawdown as well, that returns are somewhere between 11 to 30, of the entry point in the markets. And these are the periods when we are seeing highs and then very sharp corrections and the lows in the markets. So if you're a long-term investor, we can, I think, conclude that the point of entry will not matter your returns too much. And this is, a longish period we are looking at. Even if we look at the returns from 2020 January onwards, actually the XIRR is very good, because if the time period is lesser, the XIRR tends to go up. But Sonal, let's just look at the data from a 5-year SIP point of view. And that is where, we see a change. If somebody invested in 2008 and was only investing for 5 years, the person would have made about 9.5, 10% returns. But somebody who had invested in 2004 and ended his or her 5 years in January of 2009 would have not made returns. It would have been flat. And he or she would have had to wait for another 8-9 months to make good returns, and that would have taken his or her returns up to 18%. So I think nothing much to worry if you're an SIP investor. I think a bit of concern for those who are looking to invest in one go, and that is where I think the levels do matter. Because if we see, a lump sum investment done in January of 2008, Sonal, what we'll see that even 5 years later, in January of 2013, the returns were actually negative 4% if it was a one-time investment. And that's because once the markets recovered from 2008-9, again, we saw the markets dipping in 2011 by about 25%. So as far as the lump sum investments are concerned, the experience will really vary depending on when you invested, and it's a one-time investment. And till today, if that investment was held, it would give about and not too bad also, but yeah, considering the expectations from equity, I would say not great. The best active fund would have given about 10.5%, and the worst till now would have given about 3.5%. So as far as the lump sum investments go, the experience can be very varied. If we look at 2020, till now we've seen an annualized return of 13%. I think from the point of entry, and then what follows, how strong is the rally after that correction also really matters a lot. And so for for lump sum investors, I think it's good to take a staggered approach, because if somebody who started in 2008 had done that and invested over a 6-month period, his or her investments would have been 14% in absolute returns, as compared to that -4 in the next 5-year period. And if the STP was done over a 1-year period, the returns would have been up by 30%. So I think in conclusion, Sonal, what I would like to say is that, as investors, somebody who's doing SIP should continue, should not worry about the market levels. Somebody who's looking to park a lump sum should, I think, at levels where you know that it's an all-time high, can take a staggered approach, park something in one go, and I think the remaining can be done on a weekly basis, or STP, or something can be just kept in the switch can be done if in case we see volatility and some sort of a dip in the markets.
Okay, that's very, very helpful data, Prableen, to really highlight how the returns have looked and how it's different when you consider an SIP approach versus this lump sum approach. So I'm sure that will help all of our viewers a lot. But now that you started by saying that the people who make money in this market are people who participate, right? So you have to still get into the market, even if you're doing an SIP, even if you're getting in small. If someone is trying to create an MF portfolio from scratch at a time like this, what do you consider? This is just advice to anyone who's looking to get into mutual funds.
I think, Pavitra, it's so important to know where you want to go, right? So if I have to go to the market near my house, I can just walk. So if I have to park my money for a year and a half, I would not even look at equities. If I am doing something, let's say for my child, where the goal is 10 years away, a fixed income investment will not be able to meet my financial goals, because with education inflation at 8 to 10%, fixed income sort of return in the 7% bracket will not definitely help the investor. So what is important is knowing clarity on the goals, because the clarity on goals can actually give you and define your time horizon. And once your time horizon is set, then you can actually decide that, okay, this is the percentage allocation which goes to equity, this is the percentage allocation which goes to fixed income. And then within that, one can decide whether I want to take a passive approach, an active approach, which fund to pick. But I think without clarity on the investment horizon, it is very, very difficult to decide where and how to invest. But somebody who's looking to invest today and is a long-term investor, I don't think should think twice. Definitely start with an SIP in equity funds, long-term portfolios. On the fixed income side, I think he'll still look good, and it's a good time to park even as lump sum, as interest rates probably, they peaked, are has pressed the pause button. So if going forward we see inflation cooling and interest rates going down, definitely there would be a boost in the fixed income space as well.
Okay, so in that case, when we are talking about a certain period of time when you have to go ahead and invest, which category to choose, what are the factors to consider when you pick a fund house? And a fund also, is it the AUM, the expense ratio, the fund manager? Is that something that needs to be considered, or the category works?
So Sonal, I think, yes, a credible fund house is very important. We have, I think, we have increasing number of AMCs joining the market space, which is good. Competition is good for the markets. But I think if you're a beginner, start with a credible AMC. And that is because you can actually see how the equity funds from the fund house have performed during different market cycles. So you have some data there, though, of course, what has happened in the past may not be replicated in the future, but I think it gives decent guidance on how the funds are managed. Second, somebody is building now his or her portfolio should definitely look at the different investment styles. So even if I'm looking to create a very basic portfolio for myself, where I'm looking at a large cap, a mid cap, and a small cap fund, I would want inclusion of different investment styles. I think that is important. What we've seen in the last 1.5 years was, pick up in the value investing, a growth approach really didn't work. So I think different market periods sort of different approaches work, and I think that is why a combination is good. Other than that, I think inclusion of different market caps is important. So if you're going and investing in a flexi cap fund and a large cap fund, it may actually lead to a lot of duplication in your portfolio. There is, duplication as high as 75 sometimes in the large cap and the flexi cap funds from the same fund house. So I think to keep that low, it's good to move across the market cap space. And I think, again, the decision has to be, and the core is suitability according to your goals. Because once you know that this is my goal, portfolio can be created with inclusion of basic categories such as large cap, mid cap, small caps, which can create your core, and then maybe another one or two categories to top it up as a satellite portfolio.
Okay, got that. Prableen, a lot of people, when they write into us, sometimes we go through their portfolio and they just have tens of schemes, right? They write in with 30, 40 schemes because they don't know where to invest. So they've just put a little bit of money everywhere. It could be as little as 2,000 rupees in a scheme. What would you suggest is a good number of schemes to have? Because, like you were mentioning, there's a lot of duplication. Even in these cases, we see so much overlap. So what do you think is a good number of schemes to have in your mutual fund portfolio?
So Pavitra, I've seen as a high, more than 100 schemes in an investor's portfolio. The second highest, what I saw, was about 88 schemes. So what becomes so difficult is how do you take an exit call? There is so much of management which is involved, so many, related aspects which start to come. So it is definitely important to, when you're building your portfolio, if you're unsure, please take guidance. If you can do it yourself, then I think start with 3 to 4 schemes. That's good enough for majority investors in the equity space. A large cap fund, a mid cap fund, and a small cap only if you have a longish horizon. So what we saw, the data that I shared earlier does show that 5 is like sort of the critical time period, 5 years to be in the markets, because you have to have completion of the cycles. So only if you have a long time period, please invest in mid and small. So, but I think these 3 core strategies can be, good inclusion, and along with that, maybe some exposure outside India, and to cater to medium-term goals, I think inclusion of 1 to 2 debt funds can be good as well.
100 schemes in a portfolio, just wrapping my head around that, Prableen. But
stressful to think about, right?
I'm sure. So that's why we have experts who talk about how you can have a balanced portfolio as well, right? Prableen, it's an interesting chat. We'll do one thing. We'll slip into a quick break, and the other side, we'll continue our discussion on how to build your MF portfolio at such a point in time. Mutual Fund Corner on CNBC TV18. We still have with us Prableen Bajpai. We are talking all about creating a mutual fund portfolio. The ideal question, or the question that everyone asks the first time they're investing, is what would the equity debt split be, and what would it be for a high, medium or low risk profile? I know it's very individualistic, the answer, but if we compare them and if we put them in different baskets, what would you recommend?
Right, Sonal, asset allocation is the foundation of any good portfolio, because that is what governs the returns. And it's good to have that clarity in mind. What is the percentage which goes into fixed income and equities? So I think one way to look at it is for somebody who doesn't have a high risk appetite and is looking to take a conservative approach, can have about between 15 to 40% in equities. I know 40% is slightly on the higher side, but depending on the goals that that person may have, he or she may need to stretch to that level to be in equities. For somebody who's a moderate risk taker, can have 40 to 60% in equities, rest in fixed income, and usually 70% and above in equities is how we define a high risk individual in the stock markets. Now, age allocation, the other way is, of course, you look at your age, and 100 minus your age is what should go into equities. And if you're a conservative investor, probably you can do up down of 10 to 20% there. Likewise for a moderate and high risk investor. But Sonal, while we have allocation, very few people actually follow it. And what is important is that if you're having an equity portfolio, you have to sort of incrementally, once you're used to how the stock markets are moving, even as a low risk investor, the person may actually get tuned and can have a higher risk appetite going forward. So reviewing that also becomes very crucial, because your own risk appetite is also, I think, which changes with time.
Oh, absolutely. That is all important.
These are individual applications. And so we hope when all branches of HDFC mortgages, hopefully the number will increase. We don't know how much, and our numbers have gone up over the months, over the years.
I have a question on when do you think the integration is likely to be as complete as you would possibly expect it to be? These are two joint organizations that are merging.
See, the advantage from an integration standpoint is that the two organizations do not have similar products. So the bank does everything other than housing, and HDFC only does housing. And therefore the commonality of roles is very limited. It's limited to certain corporate functions. So that makes the process of integration a lot simpler than what you would see in a merger of even two small entities. Forget about two large entities. Because there you have commonality of products. If you have two banks merging, both banks have car loans, both banks have consumer loans, both banks have housing loans, both banks have, different. This is not the case here. So the integration will be easy. HDFC has 4,000 employees. So in that sense, will be much, much lesser than what you would see in a merger of two banks.
Will there be any relocation of the employees?
I mean, at the moment that is not envisaged. But over a period of time, these are things the bank will have to look at. But at the moment, it's not envisaged.
So you said the branches will continue, or?
Our branches will continue. They are not going to give up, except the board outside will be, say, HDFC Bank. And if the bank is small, if HDFC Limited has small offices, they may not be able to offer all banking services. Then it will be called a service center of the bank.
So you said you'll retire in 4 days. What will you do next?
Let me retire first, then I will.
So I had a supplementary question on the culture. So what's the kind of assurances have you received from HDFC Bank about integrating the employees of both the organizations? I mean, it's going to be a big merger. So I mean, can you elaborate on any kind of assurances about having a composite culture?
Assurances we've got from the bank and from the CEO downwards. Each and every employee under the age of 60 will be absorbed. Salaries will not, and they would continue to do mortgage loans because we need them.
currently, is there any salary-related gap? Because what you're
No,
saying,
the different pay scales and all, but that adjustment, we had an HR agency who helped us and do all that.
They'll continue to do mortgage loans, we said. If there's any
No, they could do other things also.
As in HDFC employees will continue to be involved.
Involved.
Only in home
Yeah.
loans.
Well, only in home loans, they at least to start with, unless they are trained to do other things. I'm sure the branch manager of a large.
something specific.
But your question about is that they need our people because they don't do mortgages. They don't have detailed knowledge about the builder community. They don't have any knowledge about prices of real estate because this subject was not with them.
So, would this 3,000 would work as some kind of a initial period independent unit within that? To get
No, the 3,000 will be immediately merged in the levels of the different grades of the bank, and they will be adjusted. 3,000. 4,000.
Also, what happens to those who are close to 60 and have not enough?
See, they can join the bank. It's individual's call. Some people of 58, 59 says, I don't want to join the bank. They will resign on 30th.
There is no golden handshake or PRC.
There's no golden handshake.
The way that you calculate interest rates versus the bank, that essentially changes for the industry as well.
I mean, some integration in terms of banking policies, banking regulations will take place. That's an automatic process.
Will they apply retrospectively to your existing loan?
No, it will not apply
deposit?
It will apply from the date of the
Only
merger.
for new customers.
And from the date of the merger, the choice will be given to the customer to move to the new benchmark.
And if they know, you'd have to wind up the loan or the deposit? Yeah.
I'm sorry? No, you don't have to.
Then, if you don't want to move to the new
Then you continue the way you are.
so it gets grandfathered.
Yes.
Yeah, it gets grandfathered. All assets and liabilities get grandfathered, so all depositors will get their rate of interest which we have committed until the
Tenure of the deposit.
tenure of the deposit.
But I thought this press conference was on the...
That's the problem.
video, please?
No, you ask Mantu, then Keki has got something else. You can see the video.
Yes.
Just wait for a minute for the video. Anything more, or Keki can go? He's got to
What
go.
happens to the treasury function? Because that will hold the treasury people.
Sir, I have a suggestion.
Huh?
They will get
When it
integrated.
comes to
That's all.
online, dealing with online, be it HDFC, be it HDFC Bank, securities, it just sucks.
What is he saying?
The online
Online service quality.
Service quality.
It just sucks.
Not good.
Even today, I have a loan with you, home loan with you. Even today, my balance is of last year.
Okay, well, that is Mr. Keki Mistry, Mr. Deepak Parekh addressing the press. This was an event marking inauguration of a center to honor, the founder of the group. But it's kind of turned out to be about the merger. Naturally, I mean, a lot of questions there. Actually, both these stocks, HDFC and HDFC Bank, are doing well. Merger effect. Other details. I mean, of course, most of it is now known. I think the effective date, which is the 1st of July, has also been known for a while. So not very much new in that sense. Stocks have been doing well even before, and they are, the largest contributors to the Nifty, and they are in a way the sole contributor, overwhelming contributor to the rally on the Nifty Bank as well. You're with us here on a fresh new edition of Closing Bell. I'm Prashant.